What if the biggest risk to the US economy right now isn't a crash, but confusion? Jobs still exist, spending still happens, yet millions feel uneasy. Today we're breaking down why economic uncertainty is rising and why so many people aren't prepared for what comes next. Chapter 1: US economy at a crossroads. Economic uncertainty isn't new, but this moment feels different because signals are mixed. The economy is still growing, yet key warning signs keep flashing. Hiring is slowing, job openings are shrinking, businesses are cautious, consumers are nervous. None of these screams collapses, but together it creates hesitation. And hesitation matters. When people hesitate, they spend less, invest less, and take fewer risks. That alone can slow an economy. Unlike past crises, there's no single shock causing panic. Instead, uncertainty is building quietly through data releases, earnings calls, and policy debates. People feel something is off, even if they can't point to one headline. Have you noticed how conversations about money sound more careful lately? This is how uncertainty spreads, not through fear, but through doubt. And when doubt grows, planning becomes harder for households and businesses alike. That's why understanding the signals matters now more than ever. Chapter 2: The labor market is cooling slowly but clearly. The US labor market has long been a source of stability, but signs of cooling are becoming clear. Job openings have dropped to their lowest levels since 2020, making it harder for workers to find new opportunities or negotiate better pay. Layoffs are increasing in logistics, tech, retail, and corporate services. Hiring hasn't collapsed, but the pace has slowed, changing behavior for both companies and employees. Firms are being selective about whom they hire, and workers are less confident about switching jobs. This shift affects consumer confidence because people who feel secure spend more, while those who feel unsure pull back. Even though some sectors continue to hire, the unevenness creates confusion. Employees and households can struggle to gauge the overall health of the job market. Are things fine or getting worse? Many don't know, and this uncertainty alone changes financial decisions. Understanding how a cooling labor market influences spending, confidence, and planning is key to seeing why economic hesitation is spreading across households and businesses alike. Chapter 3: Consumer confidence in decline. Consumer confidence is a critical part of economic health. Right now, surveys show Americans feeling less secure about the future. Concerns about job stability, rising costs, interest rates, and unexpected expenses weigh heavily on household decisions. Even if inflation has slowed, everyday expenses remain high, making it harder for families to save or spend freely. Many households have thin emergency cushions, and credit card balances are increasing. These factors shape spending habits. People delay big purchases, avoid new debt, focus only on essentials. Caution isn't panic, it's careful planning in the face of uncertainty. But when millions make these small adjustments simultaneously, economic momentum slows down. Retailers see weaker sales, businesses postpone investments, and the ripple effect spreads throughout the economy. This quiet shift may not make headlines, but it impacts real life. Understanding consumer behavior explains why many households feel unprepared. It also shows why economic uncertainty can grow even when key indicators, like employment or GDP, don't signal disaster. It's subtle but powerful, influencing spending, saving, and overall confidence. Chapter 4: Markets are reacting to uncertainty, not collapse. Financial markets respond quickly to uncertainty, even without an economic collapse. Recently, indexes like the S&P 500 have turned negative for the year as investors weigh slower growth, profit pressures, and labor market trends. Volatility doesn't signal disaster, it reflects caution. Investors are pricing in slower growth, tighter margins, and policy uncertainty, which affects borrowing costs and business decisions. Mixed economic data, with some areas strong and others weak, makes forecasting harder. When uncertainty dominates, risk tolerance drops, capital waits on the sidelines, investment slows, and growth decelerates quietly. Businesses adjust hiring and expansion plans accordingly, even in sectors not directly affected by layoffs. Uncertainty, unlike a crash, lingers and influences decision-making across households, companies, and investors. But here's something to consider. Have you noticed how news about stocks or interest rates affects conversations at work or among friends? This constant awareness shapes real behavior. Markets don't predict collapse, they reflect expectations. Understanding this distinction helps people recognize why uncertainty can influence financial choices long before any official economic slowdown appears. Chapter 5. Why millions are financially not ready. When we say millions are not ready, we're not talking about irresponsibility. We're talking about vulnerability. Many households have limited emergency savings. Housing, healthcare, insurance, and credit costs consume a growing share of income. Even with jobs, budgets feel tight. That leaves little room for shocks. A job loss, medical bill, or rate increase can cause real stress. Economic uncertainty exposes these weak points. People aren't prepared because the system hasn't allowed much room to prepare. Wages rose, but so did costs. Savings rates never fully recovered for many families. And now, as uncertainty grows, options feel limited. This isn't about fear, it's about math. When expenses rise faster than security, readiness declines. Have you ever felt financially stable, but still uneasy? That's the reality for many right now. The concern doesn't collapse tomorrow. It's resilience if conditions worsen gradually. Chapter 6. Federal Reserve Policy adds to uncertainty. The Federal Reserve is central to today's economic uncertainty. Interest rates remain elevated to balance inflation and growth. While future cuts are debated, businesses don't know when borrowing will become cheaper. Homebuyers hesitate, investors wait. The Fed aims to stabilize inflation without derailing growth, but mixed economic signals complicate decisions. Every statement or report is analyzed for nuance, amplifying market sensitivity. Even without new rate changes, uncertainty itself can slow spending and investment. Companies postpone expansion. Consumers delay purchases. Lenders become cautious. The longer uncertainty persists, the longer households and businesses remain defensive. But here's a question to think about. Is the Fed done raising or cutting rates? No one knows for sure. And that unknown feeds economic hesitation. Policy uncertainty affects everyday choices, influencing everything from mortgages to credit decisions. Understanding how the Fed's decisions and the uncertainty around them shape behavior is key to grasping why millions feel unprepared today. Even small changes in perception can ripple widely, affecting planning, spending, and confidence across the economy. Chapter 7. AI, automation, and hiring patterns. Beyond short-term cycles, bigger changes are underway. Automation, artificial intelligence, and efficient investments are reshaping hiring. Companies are doing more with fewer workers. That doesn't mean jobs disappear overnight, but it changes demand. Some roles grow, others shrink. Workers feel this shift even if unemployment stays low. Job security feels different when technology moves fast. Training gaps widen. Transitions take time. This adds another layer of uncertainty. It's not just about the next quarter, it's about long-term stability. People sense that old career paths aren't as reliable as they once were. That awareness influences savings, spending, and risk-taking. Economic uncertainty today isn't only cyclical, it's structural. And structural uncertainty tends to linger longer. That's why preparation matters more than prediction. The future may not be worse, but it will be different. Chapter 8. What comes next and how people can prepare. Looking forward, economists see slower growth and elevated risk. Though a recession is not certain, labor markets remain cautious. Consumer sentiment is fragile. Mixed economic signals leave many households unsure. The outcome will depend on policy decisions, global events, and confidence levels. What matters now is preparation, not panic. Understanding cash flow, reducing unnecessary debt, and maintaining a savings buffer are essential steps. Upskilling or diversifying income sources can also help households feel more secure. Awareness allows people to make proactive choices instead of reacting to sudden shifts. Uncertainty doesn't equate to disaster. It means adapting to changing conditions. Even small adjustments in spending or financial planning can have a meaningful impact. Economic cycles always turn, and those prepared feel the effects less severely. The key isn't predicting every fluctuation, it's acknowledging uncertainty and taking practical steps. Planning, adaptability, and awareness are the best defenses against economic volatility, allowing households and businesses to maintain stability even with ongoing unpredictability. Economic uncertainty doesn't mean the system is broken, it means the signals are changing. The real risk is ignoring them. Do you feel more cautious about money than you did a year ago? Comment below with your experience. If this helped, hit like, subscribe, and stay tuned for clear, honest insights about the economy.